is the biggest bank in America and also the most powerful. JPMorgan Chase moves more money in a day than most countries earn in a year. One man will rise to the top of the heap as the bank faces its greatest challenge. I think Jamie Dimon is the best in the game right now. You are the survivor. Last man standing is a dangerous place to be. In 1 year since entering the war, the American military is unstoppable, and it quickly have turned the tide against Germany and Japan. After early defeat, America's back in the fight in North Africa, where they have got the Nazis on the run. Most heartening of all is the new form against in North Africa. Some of the Nazis beaten off in their first real battle in American troops surrendered thanks partly to the world financing facilitated by the House of Morgan. American industries for the first time ever begins to operate with a unified goal. They were rivals before the war. Now they are working together. There were a writer at the time who said this were almost as if players of the New York Yankees took a few days off to win some games for the Dodgers. And now, America is greatly building the ultimate weapon, codenamed the Manhattan Project and led by theoretical physicist Robert Oppenheimer. America raced to realize the creation of the world's first atomic bomb, one that possesses the potential to instantly end the world. While Oppenheimer grappled with this seemingly insurmountable task, a dire blow triggers the American finance industry. JPMorgan Chase, the king of Wall Street, passed away, falling victim to a shock. Although Morgan was vilified by President Roosevelt for the 1929 stock market crash, in the end, he was able to help the nation by providing the financing needed for the world effort. And now, his banking empire continues on without him. JPMorgan may be gone. The American military-industrial complex he has built is now operating at a full capacity, and soon thousands of bombers and ships laden with tanks and troops will head towards Europe to take part in the biggest military offense in history, the D-Day invasion. Ladies and gentlemen, the President of the United States, my fellow Americans, I ask you all to join with me in prayer. Almighty God, our sons, bride of our nation, since they have set upon a mighty endeavor, a struggle to preserve our republic, our religion, and our civilization, and to set free a suffering humanity after 406 days. With the help of the DuPont Company, Robert Oppenheimer has acquired a sufficient amount of plutonium to construct an atomic bomb, and by July 16, 1945, the Manhattan Project succeeds, as the bombs unleashed the power of the sun, wiping out Hiroshima and Nagasaki and killing nearly 250,000 people. World War II is finally brought to an end. After World War II, European countries find themselves in desperate need of reconstruction. In Paris, the Foreign Minister of Great Britain, the Soviet Union, and French met to discuss Secretary Marshall's plan for restoring stability and peace to the nation of Europe. The introduction of the Marshall Plan opened up a new market full of opportunities for growth in the American banking industry. What can a country like the United States do to have? What about setting aside over $13 billion to help rebuild the smoldering continent by investing in the economies of European countries? The U.S. has created new markets for its exports. Many banks make great profit by extending loans, facilitating investment, and fostering trade relationships. This results in economic cooperation, leads to a booming economy for both European nations and the United States. But not all banks have benefited from this economic resources. The resources of Morgan Bank have been reservedly depleted by World War II. Without the leadership of JPMorgan, the bank finds itself struggling to remain competitive before its last Citigroup as an investment bank. JPMorgan and Company had to tower over its rivals, but as a commercial bank, it could match the more plebeian banks that counted retail deposits. Naturally, it fluctuated in size somewhere between 20 and 30. This was the first time when Morgan Bank was not being led by a Morgan family member. Remember, the business had a powerful brand because of the Morgan name. Harry Morgan began to run Morgan Stanley, a more lucrative investment banking operation. Meanwhile, the Morgan Bank, which is a separate commercial bank, is now run by someone named Henry Clay Alexander. As the head of Morgan Bank, Alexander faced a challenging decisions. Over a third of New York's bank finance, they had to merge if they were to grow to a size commensurate with their multinational clients. Many Morgan people opposed to merge because they liked working in a small, paternalistic bank with terrific perks. They thought a merger would cheapen the genius article. Finally, though, a decision would have to be reached. The Morgan Bank and the people running it always have this pride about themselves. They were very reluctant to merge with other banks because they thought they were superior. Now, Alexander must discover a way to merge with another bank and rapidly expand its international operations, or Morgan Bank will fade into irrelevance. And through a fortunate chance encounter, he stumbled upon a company that would be the ideal candidate for the merging with Morgan Bank. Guaranty Trust, one of America's largest and oldest banks, specializes in global financing by facilitating trade and investment between the United States and other countries. By 1959, the bank is grappling with severe financial troubles stemming from its loans and investments, especially in international markets, resulting in substantial loss. The board of directors blames the nasty failure on the bank's CEO, J. Luther Cleveland, and tries to remove him, but their attempts prove unsuccessful. But they soon realized there a better way to both save the firm and oust Cleveland is by merging with Morgan Bank. Approval of the brothers merge of JPMorgan and Guaranty Trust Company was announced late yesterday by G. Russell Clark, state banking superintendent. The merged bank would be known as the Morgan Guaranty Trust Company. By merging with Guaranty, the House of Morgan is suddenly pushed with over $4 billion in deposits. It had an unmatched number of corporate accounts, 10,000, including 97 of the 100 biggest U.S. companies. Alexander became the CEO of the merged firm, and the firm is instantly the fourth largest commercial bank in the country. But for Alexander, regaining Morgan Bank's dominance means it needs to become the biggest commercial bank, and to do that, the bank must explore new markets. Morgan then became a pioneer in establishing the federal funds market, Tier A marketplace where banks can lend and borrow money from each other to meet their reserve requirements and manage their daily cash flows. Riding the waves of the 1970s market boom, the banking industry experienced substantial growth. This growth is driven by the invention of ATMs, credit cards, and mergers, leading to significant evolutions within the entire banking industry. At the same time, Morgan Guaranty maintains its position as one of the top three biggest commercial banks in the country, alongside Bank of America and Citibank. But none of these banks are prepared for what is about to come. With the arrival of the 1970s, America is posed to face one of the worst economic challenges ever, and soon Morgan Guaranty will be challenged by a potential political force unlike any it has ever faced. While strenuous diplomatic efforts are being made to bring Israel gifts and other combatants in the recent Middle Eastern war to peace table, the Arab oil producing states and are continuing to widen their oil equipment against the United States, Western Europe, and Japan. The early 70s oil crisis began in 1973, when the members of Organization of Arab Petroleum exporting countries imposed an oil embargo and respond to Western support for Israel during the Yom Kippur War. This triggered substantial hikes in oil price, resulting in reserve shortage, lengthy queues at gas stations, and economic upheaval in many countries, particularly in the U.S. The Saudis began to reduce their business engagement with Western banks, but with one notable exception, the Morgan Bank. The House Morgan had been friendly with the Saudis for a long time, as early as the 1930s, and they saw Morgan as an honorable and principled institution to do business with. In 1973, Morgan begins to trade petrodollars, reaping immense profit while the rest of finance industry struggled to survive amidst the oil shock. Around that time, a group of countries in the Middle East, including major oil producers like Saudi Arabia, decided to sell their oil exclusively in U.S. dollars. The term petrodollar refers to the U.S. dollars earned by those oil-producing countries from selling oil. But Morgan Bank struck of good fortune, and its favorable relationships are about to come to an end. A formidable opponent emerged, which sought to safeguard the interests of Israel and American Jewish Bank. A senator from Idaho is coming after Morgan Bank and its peers. Amid the oil embargo, major Arab countries serve severe ties with most Western banks, particularly Jewish financial firms, but Morgan Bank managed to sustain its business relations with Saudis. Senator Frank Church from Idaho believe that this situation is deeply unjust to Israel and Jewish enterprise. In early 1975, Senator from Chas tried to extract figure on petrodollar deposits. In 1976, the American Jewish Congress signed on Morgan Guaranty and Citibank for their pivotal roles in the implementation of abrupt boycotts motivated by these concerns. Senator just took up the cause of advocating for anti-embargo legislation that prohibits certain banks from engaging with major Middle Eastern oil exporters. The introduction of the legislation is a hard blow to Morgan Bank, but for Senator Frank Chase, it remains crucial to establish a fair business environment for other banks that have faced sanctions from Arab nations. The oil crisis resulting from the Yom Kippur War hasn't shaken the global economy. It sets off a chain reaction that eats into everyone's bottom line, but Morgan Bank still managed to profit from the situation as it has for over a century. You can still find life-changing opportunities in the volatile economy. Even today, hundreds of you, my channel subscribers, have joined me in seeking that opportunity with today's sponsor, Masterwork. Citigroup recently extended its streak of positive returns, selling a Celsius Bros piece for a 77% net annualized return, and a Joy Kusama piece for 13.4%. That's 16 straight. It's astonishing that they performed well through the invasion of Ukraine, COVID, inflation, and interest rate hikes. The arts market has surpassed pre-pandemic levels. Masterwork has over $800 million in assets under management and more than 800,000 users on their platform. They are making headlines after launching their largest offering that yes, a $36 million Basquiat piece. I have invested with them for years, seeing paintings selling out in minutes. So don't miss this. Since you guys have a response to the girl, you can bypass the waitlist and get started right away. Just click the link in the description. Losing tens of millions and with the volatile international economy of the late 1970s, Morgan Bank grappled to find new avenues for growth. Amidst the uncertainty, a new leader emerged, Lewis Preston. Born in New York, Preston has spent most of his adult life abroad, residing at places like France, China, and Japan. Preston took the reins of Morgan Bank with a determined vision. The bank's survival hinged on expanding its operations beyond America from the very beginning. The House of Morgan has held a global view. Their entire business model is based on fostering relationships with powerful individuals in various countries, and this is the epitome of global capitalism. Wholesale banking involves providing specialized services like large loans, investments, and advisory to big business and institutions. It's like a back service for companies. As the newly crowded leader of Morgan, Preston decided the only way for Morgan to survive is by going back to its roots. The Morgan Bank is going to start doing business the Morgan way, providing financing to new rising countries and bailing out falling ones. The marketplace appears to be at two extremes. In both sides of the country, Morgan Bank were able to charge healthy interest rates, By early 1980s, the Morgan Bank began to bounce back, making great profit by lending money to less developed countries in Asia and Middle East. By the fall of 1979, the mood at Morgan was cautiously optimistic. The bank's close ties with Saudi Arabia and Kuwait meant that Morgan was a major recipient of deposits from them and other OPEC members. The bank also had close ties with the largest oil and natural gas companies, and lastly, the bank had a very strong balance sheet with one of the highest capital assets ratios in the industry. For Brazil, there is one particular market teeming with opportunities for huge profit: Latin America. During the early 1980s, prominent Latin American countries, Brazil, Mexico, and Argentina, confront formidable economic challenge. They face substantial debts and soaring prices, leading to inflation. This era is often referred to as the lost decade, marked by a period of economic hardships. While other banks may shun from doing business in distressed economies, the Morgan Bank sees opportunities to give out loans to help bail out these countries while charging high interest rates. In times of economic distress, these businesses and individuals might require liquidity to cover immediate expense. Banks can offer loans at higher interest rates, capitalizing on the urgency of the situation. Leo President perceived Brazil as a crucial marketplace to reach significant gains, and Morgan Bank needs to increase its dealing with the country. So he sent his vice president to Brazil with the goal of fostering relationships with local governments. A man named Antonio Gibaro possesses a unique skill set for this role. An excellent diplomat, Gibaro has a way to help the rich and powerful get what they want, and President is hoping that Gibaro's unique abilities will enable the Morgan Bank to secure favorable arrangements with Brazil. But what he doesn't know is that Gibaro has its own agenda. Tony Gibaro was leading a series illicit life as an embezzler. In 1976, Gibaro has started to divert money from some Brazilian accounts in order to furnish his duplex apartment. Gibaro apparently drew on some form of flight capital managed macro from Latin America to advance tax or exchange controls. As Brazil, Mexico, and Argentina raised billions of dollars in new loans, their disloyal, unethical nationals were stuffing suitcases with bills and flying north to open bank accounts. In a span of a few years, Gibaro assists his plan in transferring millions overseas, reaping substantial fees as a result. Gibaro soon uncovers an even more ingenious approach to wealth accumulation for himself. As the Brazilian economy deteriorates, he can capitalize on the situation by bundling the troublesome debts into what are known as junk bonds, selling them to U.S. investors at a discount and thus a high interest rate. To fully execute his audacious plan, he will need to partner up with someone well versed in the technical aspect of junk bonds, and who better than the pioneer himself, Mr. McCann. In the mid-1970s, an ambitious employee finds himself trapped in middle management management, director Abraham Lamet. His name is Michael McCann, and he's a rising star trader who makes millions annually at the firm, but he yearns to venture out on his own. He sees a way for companies with lower credit rating to have access to capital. He constructs a marketplace for what are known as junk bonds, so it's higher return, higher risk because they are largely corporate bonds and overall economically sensitive because they are lower quality. You have a higher correlations with the equity markets in general. This market rapidly expand, resulting in Michael McCann amassing a substantial fortune 6,000 miles away in Brazil. Anthony G. Bauer fell stuck. He isn't satisfied anymore by making money from embezzling money for wealthy people. He needs to make himself super rich, just like his clients, and he sees an opportunity to do just that. In 1984, he quit his job at JPMorgan and began to partner up with Michael McCann to turn bad debts in Latin America into young bonds and sell them as attractive investments to American investors. Bauer's gamble paid off. Within just a few years of starting this new venture, he makes millions in the junk bonds market, and he finally becomes a rich multi-millionaire like always dreamed about. But his dream will soon turn into a nightmare. His daring scheme that has made his rich is about to be exposed by none other than his former employer, the Morgan Banks. Antonio Gabriel, the former Morgan Stanley Teachers Company officer who pleaded guilty to misappropriating millions of dollars from Brazilian depositor accounts, was sentenced yesterday to 1% 2 years in prison. Meanwhile, he also compelled to close his strong bonds dealing with Michael McCann. The Gabriel episode casts a shadow over the reputation of the Morgan Bank, but it doesn't stop the bank from making a killing in the 1980s roaring markets. In the 1980s, the U.S. witnesses robust economic growth known as the Reagan bombs. His Reaganomics aims to boost the economy through tax cuts, deregulation, and defense spending, igniting consumer expenditure, investment, and job creation. As a result of Reagan's deregulation, the banking industry flourished. Seizing the opportunity, Morgan Banks increased its trading operation, which became a profitable venture for the bank throughout the 1980s. Morgan guaranteed even manages to rescue a major U.S. bank in Chicago. As a CEO, Laura Preston succeeded in maintaining and fortifying the bank's position as one of the most influential and profitable entities on Wall Street. He retired in 1989, envisioning a brighter future than ever for Morgan Bank. Likewise, T. Preston, chairman of JPMorgan and Company through the 1980s, said yesterday that he would take early retirement at the end of the year and named Dennis Weatherstone as his successor. But what Preston didn't know was that around the time of his retirement, the U.S. real estate markets were spiraling downward. In the early 90s, the United States faced a several real estate downturn with plummeting value, high foreclosure, and a recession. The U.S. commercial real estate market plummeted in the first quarter of 1990s, and the sell-off continued for the rest of the year. As the economy slipped into recession, the real estate crash had made Morgan Bank rethink its approach to risk, and around that time, the bank started investing heavily in research and development, trying to figure out better ways to manage risk for the bank. A brilliant young woman is hired to lead the efforts in developing risk management technologies, believe Masters. Soon, she and her team pioneered a new type of financial instrument, a derivative called credit default swap. Credit, which is a vital part of the lifeblood of any economy, the global economy became and the thinking was that would be more readily available access and unambitiously positive thing. Blatter must believe that the use of credit default swaps will help the bank manage risk more effectively. In the end, CDS will be responsible for one of the worst financial recessions in history. But during the 1990s, JPMorgan maintained its risk-averse approach. While other banks began to expand rapidly, the Glass-Steagall Act is a century-old legislation that prevents commercial banks from merging with investment banks and insurance companies. Thanks to lobbying efforts, the legislation is repealed, allowing banks to merge with investment banks and insurance companies. The age of mega banks has arrived. Why do we have big banks? Well, because banks like monopoly power, because banks like lobbying power, because banks don't want when we're big, they will be as the industry goes through rapid consolidation. JP Morgan is now forced to do the same. To stay competitive, it once again needs to merge with another bank. There is one bank with an enduring history that makes be the perfect partner for JP Morgan Chase Manhattan. Manhattan Bank, known simply as Chase, boasts a history that spans 2 centuries. Its origin traces back to the water supply company, and over time, it has transformed to merge into the Chase National Bank and Trust Company in 1926. Subsequently, in 1955, it embraced the name the Chase Manhattan Bank. While Morgan Bank excels primarily in wholesale banking, Chase Bank is dominating the retail banking arena. In the year 2000, at the helm of Chase Bank is Bill Harrison, a leader who personifies humility and work ethic. But in order Chase Bank to flourish within the realm of mega banks, Harrison recognized the imperative need for Chase to expand its scale, and the only way to do that is by merging with another bank. Chase Manhattan has agreed to acquire JP Morgan for about $36 billion in stock, creating a union between two of the oldest and most prestigious financial firms in the United States. The boards of both companies have approved the deal. The company said in a statement earlier today. The combined company is instantly one of the largest commercial banks in the world. William Harrison is crowned as the CEO of this new bank. He's faced with the impossible task of integrating two banks into a coherent entity. So in terms of rolling success, you have to again you can't overpay you have got have a strategic reason, and then you have to know how to integrate. Yes, little does he doesn't know a storm is brewing, originating from the most unlikely and unimaginable place. In the early 2000s, Enron stand as a beacon of corporate success, promised vast wealth, but beneath its impressive exterior lie a complex maze of executive falsified financial records, creating a mirage of profits. Employees missed by these illusions lose their investments. Crystal liberals expose the fraud, leading to the eventual downfall of the company. Guilty verdicts in the biggest cause of corporate fraud in history. 38 counts of fraud and conspiracy. The Enron scandal tarnished JPMorgan's reputation, and result in the bank includes in hundreds of millions in the fine. As Harrison approached his retirement age, the company's board eagerly reaches for a successor, someone who possesses the ability to steer the ship in a new direction, someone who embodies the ruthlessness that Horizon lacks. In 1997, an up-and-comer, Jamie Dimon, found himself falling to rock bottom, betrayed by his mentor. After spending years working alongside Citigroup, Jamie Dimon helped create the world's largest bank through a series of deal-making Citigroup. Jamie Dimon then became the heir apparent to succeed Sandy well as the CEO of Citigroup. Just when his ascent to the helm of Wall Street seemed inevitable, Jamie Dimon was unexpectedly fired by Sandy Well. Jamie Dimon, the president of Citigroup, the world's largest financial service company, suggested that he would leave the company, a surprising move that raised questions about who will ultimately be tasked to manage a sprawling giant created by the recent merge of Citigroup and Travelers Group. Dimon knows it's only a matter of time before he makes a comeback. Dimon is then hired to become the CEO of Bank One in Chicago, a firm that is teetering on the edge of bankruptcy. But through less cost cutting in just 2 years, Dimon turned the bank around from the edge of collapse to making hundreds of millions of dollars in profit. For the first time in a long time, Dimon's success at Bank One has caught into the attention of JPMorgan Chase. As far as the board of JPMorgan Chase is concerned, Dimon is exactly the type of leader they need. And to hire Jamie Dimon, they are going to acquire Bank One. JPMorgan Chase has agreed to acquire Bank One in a deal valued at about $58 billion that would bridge the competitive landscape among the world's global banking giants. The two companies announced the evening after 1 year since JPMorgan Chase acquired Bank One. Jamie Dimon succeeds Harrison and becomes the CEO of the second largest bank in America. For Dimon, it's only a matter of time until JPMorgan Chase becomes the one. When he examined the data of his bank and his financial industry in 2002, he finds some alarming information. At the time, all of Wall Street was going crazy with some prime mortgage loans. For example, Goldman Sachs makes hundreds of millions of dollars a year from issuing mortgage securities, and Morgan Stanley was also making a comeback through subprime loans. But Dimon believes the mortgage assets imply unforeseen risk, and he is willing to go in the opposite direction in order to protect the bank's future. In just 2 years, Dimon is proven to be right, as the world is plunging into the worst financial crisis in recent history, which troubled for millions of American homeowners. As a slowing housing market has turned some mortgages into time bombs, Wall Street Bank may not have enough money on hand to stay in business. One of the first Wall Street banks to fail is Bear Stearns for prevent a chain reaction of bank failures. The government needs to find a bank fix enough to acquire Bear Stearns, and they turned to Jamie Dimon for help. It was like buying a house. That was buying a house on fire. We thought we saved the city. We thought that would have been the domino that would cause the whole system to go down. It's good because that JPMorgan was strong that we could do it. Saving Bear Stearns isn't enough to prevent the future deterioration of the financial system. Soon, JPMorgan Chase is asked once again to recruit another financial institution. Washington Metal is astonishing because just like how JPMorgan bailed out the financial industry during the panic of 1907, after over 100 years, Jamie Dimon is also being asked by the government to help bail out the industry. Every crisis, JPMorgan always emerges bigger and stronger. After the 2008 financial crisis, JPMorgan Chase is once again the biggest commercial bank in America, and Jamie Dimon is now the undisputed king of Wall Street. But like all men apart, they become targets. In just a few years, Jamie Dimon will come face to face with his biggest challenges. The Senate panel is doing a scathing report of JPMorgan's $6 billion trading loss last year. Same bank executives ignore glowing risk they hit lose from investors and from federal regulators. In 2012, JPMorgan traded Bruno Excel, a massive, huge derivative position on behalf of the bank's chief investment office, hoping to profit, but the position got awry, leading to enormous loss of over $6 billion. The risky bets are initially concealed, but as the market uncovered the extent JPMorgan now faces one its most public figure, Jamie Dimon is soon asked to appear before Congress to give a testimony about the trading loss. We believe now that a series of events led to the difficulties in the synthetic credit portfolio. In hindsight, the CIO traded did not have the requisite the precise understanding of the new risk they took. This portfolio morphed into something that, rather than protect the firm, created new and potentially larger risk. As a result, we have let a lot of people down, and we are very sorry for it. But Jamie Dimon's apology wouldn't be enough. In the eye of angry public, they are now convinced that bankers at JPMorgan Chase have put the depositor money at risk, and this gives the politicians enough support to find JPMorgan another $320 billion. A couple months later, we see the bank announcing a huge loss. We see it asking of me Cooper in his annual shareholder letters, where he kind of apologized and says it was the biggest and stupidest mistake that he made, and he promised shareholders it would never happen again. The London Wall trading loss may have tarnished the bank's reputation and cost the bank billions, but its presents no challenge to Jamie Dimon's position as the chairman and CEO of JPMorgan Chase. Jamie Dimon will once again lead the company to new heights as the country stands on the precipice of one of the biggest booms in history. After 2012, the bull market returned and the global financial markets experienced unprecedented rapid growth. The era of easy money has returned, giving rise to cryptocurrencies, especially Bitcoin and fintech companies. Neighborhood benefiting from low interest rates and market participation, JPMorgan Chase has expanded its assets from $2 trillion to $4 trillion since 2010 amidst the market's euphoria. Jamie Dimon maintained a cautious approach. I could care less about Bitcoin. I don't know anything about it. I don't personally understand the value of something that have no actual value. You can do whatever you want, and I don't care, okay? Beneath the roaring markets, a crisis begins to take shape. Following a decade of money printing, the U.S. economy finds itself grappling with a dangerous level of inflation. For the month of May, that matches the all-time high in this cycle. As the country grapples with inflation, the Federal Reserve is compelled to raise interest rates by reducing the amount of money available in the economy. Rising interest rates make it more impactful for banks to borrow money from the Fed. Within months, dozens of banks declare bankruptcy. The banking crisis worsens as a major bank in California suddenly finds itself unable to sustain its business. SVB was a textbook case of mismanagement, thus it failed to manage basic interest rates and liquidity risk as well. But the troubles don't end there. Meanwhile, after the collapse of Silicon Valley Bank, another major U.S. bank reaches its breaking point. The First Republic, a bank serving high net worth individuals, through its collapse, the wealth of many affluent Americans will be in jeopardy. The federal government is determined not to let that happen. Regulators began searching for another bank to acquire First Republic, one with enough capital to absorb the shock. As far as the federal government is concerned, only one bank is capable of such a feat. In under 2 decades since the housing crisis, JPMorgan Chase is once again called upon to bail out the banking sector. First Republic will now be taken over by JPMorgan. That's the bid that the FDIC has accepted by 2023. Over 100 years since its founding, the bank still wields a tremendous amount of power and influence. The essence of JPMorgan has remained consistent for over 100 years. Its heavy own way begins slightly more conservative than other banks and maintains good ties with the government, not just in the U.S. but around the world, and more importantly, it remains a bank that can be relied upon in times of crisis. And let's not forget, the bank was also referred to have found a leader who possesses almost the same character and determination as JPMorgan himself. Jamie Dimon, Fire News.